G'day everyone. Today I just wanted to give you a little bit of an insight into the success of the JBS investment philosophy. And while we joke with clients sometimes that investing is the fun bit at the end of a great strategic plan we put in place, it has actually proven over a longer period of time to be a really successful one and something that we're really proud of. So today I wanted to share 4 little tips that we use with our clients to allow that not only do they get great strategic advice, but they also have investment solutions that are suitable for their needs. So the number one thing that we want to talk to when we talk to clients about investing is truly understanding what you're investing in. And then when it comes to the point of investing, making sure you stick to quality assets. So as we've seen in the GFC or in the recent correction sort of 18 months ago, what clients really don't like is surprises. And if you really truly understand what you're invested in and its quality assets, then you'll end up in a situation where you don't have that many surprises. Even when there's corrections in markets, you'll understand why that is and what that's been affecting through to your investments. So it's really important to understand what you're invested in. And in our view, stick to quality, because quality is the first that bounces back when there's some turbulent times. The number 2 tip I wanted to share with you today is keep it simple in relation to defensive assets. Often people try to use their defensive side of the portfolio to get 1 or 2% above cash rates or term deposit rates in an attempt to try and boost returns. In our experience, we would prefer to see an allocation to defensive assets that you know are going to be there when it really matters and are not going to be frozen like they were in the GFC and are able to be sold and not have liquidity issues. So really ensuring that your defensive assets are defensive is a really key core strategy for us at JBS. Number 3 is understanding corporate actions. Now, as you know, our investment philosophy is all around direct assets, whether it's direct shares, direct ETFs, direct cash, term deposits, bank hybrids, these sorts of things. If you've got a direct share portfolio, you really need to be able to take advantage of the corporate actions, because participating in things like share purchase plans, buybacks, if they're in the right entity, can really boost your after-tax returns when you take account for all the franking credits and the like that you're able to pick up. So really understanding corporate actions and taking advantage of them is a great strategy for investments. And our 4th one, if you are in retirement, what we feel is really important to have a certain allocation to cash for funding pension payments. So often we talk to clients about what's their risk profile. Do you want to have somewhere between 2 or 3 years worth of cash sitting there to be able to weather the storm if you go through volatility and volatile times? Because it's really important to understand if you have to sell an asset, whatever that asset is, if you had 1,000 shares, for example, in whatever it is, and you had to sell those shares at a low period of time in order to fund your pension payments, it takes a lot longer for 900 shares to get back past the value of where 1,000 shares were. However, if you had a certain allocation of cash there to be able to fund your living expenses or your retirement income, and then when you combine that with dividends and other sorts of income coming into the fund, it gives you a longer period of time to be able to weather the storm and ride through volatility. So I hope that gives you a great insight to the investment philosophy at JBS. And if you'd like to have a chat to any of us about that, feel free to get on the phone. Cheers.